Hello, good morning everyone, or good afternoon I should say. This is Andrew Rosen, one of the partners here at Diversified. I'd like to welcome you to our next installment of our Wealth Webinar series, A Year in Review and the Year Ahead. In a moment I'll welcome our Chief Investment Officer, Mike Horwath. Per usual, we'll look to keep this about 30 minutes to get you back to your day to make this as efficient as possible. We'll not be taking questions today, as Mike has a lot to get through, but please feel free to reach out to us after the webinar with any questions, and we'll certainly be happy to answer you for them. So with that, I'm going to pass it to Mike, and he is going to inform us and educate us. Take it away, Mike.
All right, I'll do my best. So welcome, everybody. Good afternoon. I appreciate you taking some time out of your day to hop on a quick webinar. We usually do these 2 times a year. The idea is to just recap what happened over the previous 6 to 12 months in markets, right? What we've seen, what we expect, what's working, what's not working, things of that nature. So diving into the agenda, just wanted to spend a few minutes recapping 2019. I think that's a great place to start. And then turn the page. What's happened so far this year? And is that different than what we saw in 2019? What's changed from, as we've turned the calendar? And then kind of circle back to 2019, what, drove markets? What were the things that assisted, detracted? So what really drove markets in 2019? And then I always like to, and I feel like this has been a topic since really 2016 or 2017 when we started doing this, that the question we get is a recession imminent? And it's a natural question. So I want to just talk a little bit about that, where we're at today. I'll steal the punchline a little bit that it's not something we expect tomorrow, by no means. But it's a good conversation. It's a worthy conversation. And let's talk through what's working. And then wrapping it up with a summary and economic outlook, just discuss what are the concerns, because we certainly need to be cognizant of what are the concerns in the marketplace, what are things that could exacerbate, market volatility or things of that nature. So we'll wrap it up with that. So I know this is a busy screen, but we're changing up the charts here, and I think it's a good diagram of what happened in 2019. So starting in the top chart, and I'll circle a couple of things where I would focus your attention. The idea is that top 9-box chart describes really the 9 different styles of U.S. equity investing. From top to bottom, it's large cap, mid cap, small cap. So large, mid, and small companies, kind of as shown on the left-hand side. And then from left to right, it's value, blend, and growth. Those are different styles of investing. So most people think of the market as the U.S. large cap space. The S&P 500 is always a good example. The large cap blend space, I used here the Russell 1000 index, very, very similar to the S&P 500 index. It's U.S. large companies. 2019, the idea behind this chart is to really show red for negative returns, green for positive returns, and to show where things are working and where they're not working. You can see there's a whole lot of green. There's no red here. 2019, by the end of the year, was a very, very strong year. U.S. large cap up around 31%. U.S. large cap had a great year. And if you actually look out to the top right, U.S. large cap growth, that was the best performing style in 2019. And it really has been a top, if not the top performer over the last 5 or so years. When we say large cap growth, I think the most common things you could think of are U.S. tech, the alphabet, which is Google, Amazon, Apple, companies like that. So as you go down the spectrum, you see large companies outperform small companies, even though they did have very strong years in 2019. Now we focus down to the bottom left-hand corner. If we look at international markets, so there's 2 numbers that really reflect that. You have the international, which is international developed. The examples I always give are Germany, Japan, Australia, the big developed nations, and then emerging markets. Those are the BRIC countries, Brazil, Russia, India, China. You see strong positive returns, 22% in 2019, 18% for emerging markets. So across the board, when we look at the top and the bottom left-hand corner, stock markets did really well in 2019, and we'll discuss why in a little bit. Once again, U.S. outperformed international. Emerging markets actually lagged a little bit in 2019. Much of that is due to U.S.-China trade tensions, stuff like that, and we'll discuss it in a little bit. But by and large, if you were invested in equities, you did really well in 2019 across the board. The other interesting thing is when we look to the bottom right, we're going to talk about investment-grade bonds, right? Bonds, municipal bonds, things of that nature. These are the more stability-oriented pieces of your portfolio. Remember, bonds are used for diversification away from the stock market. They're used for income. There's different types of bonds. You have government, corporate, mortgage-backed securities, emerging market debt, things that are issued by emerging market countries. So what did we see in 2019? Well, across the board, your bond portfolios were up in that 8 to 9% range. That's certainly not something we expect. That's not the expectation we set for a longer-term period, but quite a good year for even the more conservative piece of your portfolio. So across the board, a whole lot of green. Turn the calendar over. What do we see so far? This is January 2020, right? This is the first month of this year. A small sample size. But if we look at those same areas, U.S. large cap, pretty much flat through January. Pretty much flat through January. If we fast forward these past 2 weeks or 12 days, whatever we're at today, U.S. large cap is now actually up about 4%. We've had some strong appreciation over the last couple of weeks. But you saw through January, U.S. large cap was pretty flat. In the bottom left, and it's really no surprise because of the items that have dominated news and stock market news coverage. The coronavirus has really been the primary conversation. So when we see emerging markets and international markets down -2 and down over 4.5, it's not a surprise. Now, similar to U.S. stocks, both of those over the last 12 days have come back a couple percentage points. But it is worthy to see how the coronavirus in January really affected international markets especially. That ties once again into the bond market where we continue to see stronger returns. A big part of this is what happens when volatility picks up in the stock market. Many investors sell stocks, exacerbating losses, and they buy bonds. A lot of times it's government bonds or higher quality corporate bonds. So what does that do? That picks up the demand for U.S. investment grade bonds. And the prices, if you were holding those bonds, the value that you're holding has now increased because the demand for that has increased substantially. So as volatility with the coronavirus picked up, stock market sold off a little bit, we see that investment grade bonds have also performed well over the last month. And if we fast forward to today, those numbers have come down a little bit, closer in the 1.8 range, but still a very, very strong start to the year for that conservative piece of your portfolio. So what drove markets in 2019? We saw 20, 30% returns in international or domestic stock markets. We saw 8, 9% returns in U.S. bond markets. So the focus probably should be on two things. It should be on the Federal Reserve and a reduction in geopolitical fears. And these are the two main data points that I would focus on for really the strong 2019. If we rewind back to the fourth quarter of 2018, if you remember, at the end of 2018, we just went through 3 months of pretty strong volatility. Some equity markets, some stock markets were peak to trough down about 20% in a 3-month period. A big reason for that was U.S.-China trade negotiations have really picked up, right? The tensions have picked up, not the negotiations. I should correct that. The tensions have picked up. Additionally, the Federal Reserve in 2018 had raised interest rates several times. So markets really got skittish in the fourth quarter because now you have the two biggest economic powers in a trade war, and you have a Federal Reserve that's raising rates, making it harder to take out debt, making it more expensive to take out debt, and now there's a concern of a really slowing economy going into 2019. When we look at what actually happened in 2019, the Federal Reserve dialed back their stance on interest rate policy. They said instead of raising rates, we're actually going to now dial them back again. Coming out of the financial crisis of 2008, 2009, the Federal Reserve took interest rates to the floor. They took them as low as you could go, pretty much. And then we did, over the last 3 or so years, we saw the Federal Reserve slowly picking those up, trying to normalize interest rates. The market maybe felt as if it overdid it to an extent, at least to where the economy stood at that point. So the Federal Reserve said, we're going to cut rates. They did 3 separate times in 2019. What does that do? That gives investors a little bit more positive feeling on the ability to obtain credit, that they're not going to overshoot interest rates, and that making it harder for investors to obtain, and really corporations to obtain credit in those markets. So the Federal Reserve cutting rates. Additionally, phase 1 of the U.S.-China trade discussion, which, take phase 1, it is what it is. What does it mean? We'll see. There's going to need to be multiple phases to this. But the moral of the story is a little less uncertainty for the market. That's really the moral of the story. A little less uncertainty. Now, the U.S. and China have agreed to at least a phase 1. The two biggest economies from a GDP standpoint, the two biggest really trade powers that drive global markets, they really settled markets from a news standpoint. There's less uncertainty. We still have uncertainty moving forward, but that uncertainty has lessened, at least in 2019. And markets really responded. Markets did respond pretty well in 2019. I think Brexit, before I move on, but the Brexit's also an interesting one because it kind of got swept under the rug. So the fact that Brexit was not a prominent piece of news cycles and investor decision making was an interesting point, and the fact that it wasn't so prominent was a good thing, at least from a market standpoint in 2019. But we continue to see slow but positive global economic growth. We see the U.S., it's not growing at 5%. We're not saying it's growing extremely fast, but U.S. GDP growing at 2.5% is a good thing. It's still growing. We're not contracting. Remember, recessions have to be driven by negative economic growth. So the fact that we're slow but still positive is certainly a good thing and was a good thing for markets. And then additionally, remember, when we look at companies and if they're overvalued or not, it's not only the price that they're trading at. So just because their price goes up isn't necessarily the biggest driver. It's the underlying fundamentals. So companies, while earnings weren't growing as fast in 2019, we did see earnings still supporting the prices we saw. So earnings did slow a little bit, but earnings were still supportive of the prices that we're seeing, the growth that we're seeing in 2019. So fast forwarding to this conversation of, recession concerns. Should we be concerned about a recession tomorrow? The answer to us is no. And it's a couple fold. One, we are long-term investors, so we know we can't time when a recession is going to come, but we know we can weather through it, and we're investing for the long term. And then when you actually look underneath the hood today, there's a lot of things that are supporting markets that should prevent any imminent type of recession. We fast forward a year or two from now, that may change, but it's certainly something today we look at as not a huge concern. So this chart on the right here really is describing and showing the strength and length of prior bull markets, prior expansions. Today we're at that light blue line. So what does that tell you? It's been a long If you look on the left to right, that describes the number of quarters. So how long was the expansion? You can see we're very long. And that's usually the comment we get is, look, it's been a long time since March 2009. Should we be concerned? The length is there, but what's not there is the strength. From south to north, from bottom to top, that's describing the strength of recent expansions going back over time. And you can see it's been a very slow, methodical growth pattern. So I would focus on the strength, that we haven't grown so fast and so much that things have to reverse course to almost reprice themselves. But it has been a long time. But I would focus on strength, not length. And I would also comment that as the U.S. economy has matured, as a lot of these data points are from the 50s and 60s and 70s, as the U.S. economy has matured over time, these things have just lasted longer. U.S. expansions have just lasted longer, and it's likely a product of just a more mature economy that's not as fast growing and that has a very diverse set of industries underneath it. Additionally, U.S. unemployment is at 3.5%. So by economic standards, or if you're an economist, usually you're looking at a 4% unemployment is what you would almost refer to as full employment. It doesn't get much lower than that. So there's always going to be some element of unemployment, but at 3.5% is probably as low as it's ever going to go. So people are working. The U.S. consumer is a big part of what's keeping this thing going, as people are spending money. People have access to cheap credit, right? Interest rates are very, very low. It's easy to get a mortgage. So the fact that people are working and interest rates are low, it should help from a consumer standpoint, which is one of the biggest pieces of U.S. GDP, to continue moving forward. Additionally, we expect the Federal Reserve, we spoke about it earlier on 2019 specifically, but moving forward, our expectation is that the U.S. Federal Reserve will likely keep interest rates pretty steady. They'll also continue adding money to the global market, or at least to the U.S. market. So buying bonds, which pumps money into the U.S. economy. So we expect the U.S. Federal Reserve to continue to be accommodative. And as long as inflation stays low, they don't have too much of a reason tomorrow to raise interest rates. That is the one caveat, is that the Federal Reserve's job is to monitor and maintain unemployment and inflation, those two main bullet points. So if inflation starts picking up, the concern becomes they will feel the need to raise rates to try to temper inflation beyond their target of really what's 2%. So inflation is nowhere near that, or at least nowhere near a point where they are at that decision point, but it's something to keep in mind. Reduced trade concerns are very important. So the fact that the U.S. and China have calmed their tensions is very important for global markets and expectations, and keeping really consumer or investor sentiment going. We'll see what happens moving forward, but the fact that the U.S. and China have, I guess the best word is kind of slowed down the concern for a U.S.-China full-on trade war where tariffs are being slapped, because no one wins that. So that has kind of abated a little bit as well. And then lastly, stock market valuations. So while the stock market over the last 10 or so years has run up pretty well, we don't see valuations extremely high. The biggest concern, if you look back at 1999, the tech bubble, was these companies were trading at extremely high prices for no earnings that were being generated. And at some point, if you're not making money, that comes back to bite you pretty hard. So that was the big driver behind the tech bubble. You fast forward to today, while the prices are certainly pretty high, the valuations aren't as high. That's really driven by corporate earnings, pretty strong. So as long as these companies are meeting earnings expectations, we should continue to see a U.S. market and a global market that that continues to move forward and not a ton of volatility, at least in the short term. I always like looking at this dashboard, and I'll just explain it real quick for you, that these are different, if you look on the left-hand side, different economic indicators or market indicators. The blue range is a typical range that these things fall. And what I like to really look at these things for periodically is anything extreme? And if it is, should I be concerned? When you look at this today, you really see that a lot of these data points fall right in the typical range. And the ones that don't aren't necessarily a major concern. So if you look at the third from the bottom, that's unemployment. So the fact that unemployment is lower than its typical range isn't a concern. If you look at the top, the second one from the top, U.S. Treasury yield, 1.92%. It's not something that while interest rates are low and they will have to go up at some point, it's not something that I'm extremely concerned about today. So there aren't a lot of data points that are extreme when we look at different market data points and we see the consumer spending money. So moral of the story to us is there's a lot of positive in markets today, and we'll talk about some of the concerns that we need to keep in mind. But today, a recession being an imminent thing is not something we're overly concerned about, at least in the short term. So our outlook moving forward, or at least what we're thinking about moving forward. The bad news, and I don't know, maybe I shouldn't call this the bad news, but these are the concerns that we need to be cognizant of. U.S. equities, and as you'd expect after 10 years, over 10 years of growth, they're expensive. They're not cheap. They are not cheap. But earnings have been strong, so valuations aren't overvalued. But the stock market is expensive, and we need to remain cognizant of how can we position our portfolio to areas that are maybe a little bit more attractive from a valuation standpoint. And those next three, the biggest concerns we need to keep in mind are really geopolitical concerns. U.S.-China trade discussions, if things fall apart there, well, markets are going to get hit. If U.S.-China negotiations don't continue progressing or they get stalled, there could be certainly some volatility picking up in markets, so it's something to keep in mind. And don't forget about Brexit. Brexit's still going on. It kind of got swept under the rug to an extent with all else that was going on, but Brexit's still there. The UK still needs to figure out how it's separating from the EU, and all of those discussions really need to happen. But it's happening. It's still there, something that we need to keep in mind. And then lastly, anytime it's an election year, what it comes down to, left or right, we're not here to talk about that. We're here just to say uncertainty brings volatility. Anytime that there's uncertainty, it can bring volatility. So we'll just encourage that you keep on top of these things. Geopolitical fears are always there. But it's an election year. There's going to be a lot of news headlines about policy this or policy that. Let it play out. Remember that the volatility a lot of times will get bred from just uncertainty of what's going to happen. So what's the good news? What are things that we still have going for us? We've talked about a lot of it. Low positive growth expected to continue. We really do think that the U.S. market will continue to grow. It may not be, like I said, at 5%. But if U.S. is growing at 2.5%, that's certainly something that can keep markets moving forward, and it's a positive sign for investors. The biggest thing is that global monetary policy, this is not just a U.S. thing. Many central banks, whether it's the Federal Reserve in the U.S. or the Bank of England or European Central Bank or Bank of Japan, a lot of these banks are being very accommodative. And what that means is that they're keeping interest rates very low. They're pumping money into their economies to try to keep stimulating economic growth, especially for the consumer and businesses. So they are very accommodative, and that should continue to allow for global markets to continue progressing forward. And as we continue to see that global growth, there are opportunities where we think international markets are poised for some pretty good growth. We talked about how the U.S. is a little expensive relative to its history. Well, international markets are actually probably in a better spot. Emerging markets, ironically, are probably, even though you have the volatility of what we've seen with the coronavirus and trade tensions, emerging markets are very attractively priced relative, especially to the U.S. So this is just an opportunity looking forward as an area that's a little bit less expensive than U.S. equities. We still fully believe in domestic stock investing. It's just looking for areas to diversify, of course, and then areas of opportunity. And then, with all that is these trade tensions have subsided quite a bit, at least when we think about where we were in 2018 at the end of the year. They have subsided, just something to keep in mind going forward. So there's a lot of good things going for the market. There's certainly items that we're keeping an eye on. So that's really where I'll leave you tonight. That's where I'll leave you today. I appreciate, once again, you taking a half hour or so out of your lunch time to sit on this. I hope it was valuable. As Andrew mentioned earlier, if you have any questions, please reach out to Andrew, Dave, or Kyle. We'll be happy to answer anything you have that we maybe couldn't get to today. But until next time, I'm going to pass it over to Andrew here, but I appreciate you hopping on and look forward to talking to you soon.
All right. Thanks, Mike, for your wisdom as always. We are recording this webinar, and we'll have it posted on our website for easy access. And as always, please feel free to share with anyone you think would get benefit from it. Also, please save the next date for our next webinar, which is on April 8th, and that will be on healthcare and retirement. So thank you. Everyone have a great and wonderful day, and we look forward to speaking to you all soon. Take care.